Japanese companies and the Japanese economy have been used to this type of environment for many, many years. So I guess if there is an experiment on negative rates, then investors need to look to Asia and look to how markets behave in that environment. So there's a precedent already established here. I think for the US and for European markets, stock markets that is, that's much more of a worry because again, in that territory, it's unprecedented.
It is, but given that a lot of the credit flow, Jim, across the world, and I'll come to equity markets in a bit, but a lot of the credit flow across the world, a lot of the debt flow across the world is dollar denominated. Wouldn't that lead to distortion in credit markets? Wouldn't it hit sentiment if the Fed were indeed to look at that option somewhere down the line?
Okay, so again, I mean, looking at equity markets in Asia, what we have here are companies which are, on the whole, quite well funded. So if you take the big markets in Asia, China, Japan, Korea, Taiwan, these companies are sitting on net cash balances. Now, on the other hand, if you look at markets like the US and look at markets like the UK, companies there have much more efficient balance sheets. That means their capital structure has encouraged them to borrow money. So where these companies go through a period of decreased demand and revenue goes down, these companies are having to shore up their balance sheets and look to credit markets. Companies in Asia, and be mindful that Asia is very dominated by big Japanese, big Korean, big Chinese companies with strong balance sheets. And I would say that Asia is a very different situation to the rest of the world.
How resilient do you think Asia would be from an investment perspective, from a market perspective to what's happening in the West? And what is it that you're advising clients to do in this sort of an environment in terms of scouting for opportunities in this part of the world?
Yes, I think the metric that investors have been looking at historically is earnings growth. But that metric is no longer relevant in the sense that I don't think any investor really knows where earnings estimates are going to get to for 2020 or even for 2021. So I think investors are having to shift their attention to the balance sheets and look at the cash positions or debt positions of these big companies. So that's the real difference. And I think the other thing which investors will look to is we've got this situation of perhaps negative rates in Western markets. What does that mean for US Treasuries in terms of their yield? What does that mean for income producing assets? If you're an investor and you need to generate income for your policyholders, where do you get that income from? Now, interestingly enough for us, we've been doing a bit of a study on dividend growth historically for the major equity markets globally. And what we're finding is actually that Japan, oddly enough, has got the best track record in delivering dividend growth over the last 5 years or so. And of course, there's a lot of home country bias in a number of these global income funds. They tend to be very underweight Japan. I think that could change. So I think Japan, quite insulated from some of these trends we're seeing in Western markets, and that means that the spotlight might shine on Japan once again.